In this week's update, cautious optimism in the face of geopolitical uncertainties. Which commodities are performing the strongest? And is it time to adjust portfolios? My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information presented in this video is of a general nature only. This video was recorded early on Sunday morning, and when I finished recording, I received news about the US attack on Iran's nuclear facility. So this is a insertion into the video post the event. So the important thing is that it doesn't change the thrust of what I had said in this video, but it does firm up one of the key points of uncertainty, obviously, whether America would enter this conflict or not. But they've certainly stressed that in taking this action, for them, the next step is peace. So that is the main message from the US. Now, when it comes to the market reaction, it remains a complete unknown. So I don't think what has happened this morning, Sunday morning, changes anything. It still remains a complete unknown. And just in terms of a bit of guidance for investors, please don't fall into the trap of trying to extrapolate what this might mean for markets, because it's completely unpredictable. We got no idea. And just the process of extrapolating and trying to get an idea of what it means for markets plants the subconscious seed in your mind that is a distraction. It's unhelpful. It's highly likely that whatever answer you come up with is going to be wrong. And so what you've done is you've planted a thought that you may or may not act on that is probably going to be wrong. So the answer is just manage risk in keeping with your own psychology. It's the same message that I've been giving month after month, year after year. Nothing changes. All right, another topsy-turvy week. Ended a bit on the soft side in America after a shortened week, but we've got uncertainty in absolute spades. I think that's the most definitive thing that I can say. We've got uncertainty around war. Obviously, the Middle East is top of mind for everyone at the moment, but we've got hotspots elsewhere. People are questioning what actions China might take over Taiwan, what actions Russia might take in respect to supporting Iran. I mean, there's just so many uncertainties, so many unknowns. It really doesn't bear thinking too much about in terms of investing, because we can't possibly know the outcome. And I'm sure even the major players don't know the outcome either. And then we've got tariffs, huge uncertainty around tariffs. Is it going to be a bit of a non-event in terms of economic impact, or have we just not seen the impact yet? So that's a big question. And then just on the broader economic situation, there's lots of changes happening in America under the Trump administration. The Fed held rates steady. The consensus, but by no means overwhelming consensus, is that there'll be 2 more rate cuts by the end of the year from the Fed, which is obviously a positive for equities markets. But is it a situation where the impacts of what's happened with tariffs just hasn't kicked in yet, hasn't manifested? The damage has been done, but we haven't yet seen it. So all these things are up for debate, but at the end of the day, the best course of action is to just trade what you see. Trade what the money flows are actually doing, because that's how you make money. You make money by getting an accurate understanding of where the money is actually flowing. So that's where we sit at the moment. As always, we strongly advise that you get all the relevant advice before you act on any of this information, and that includes financial, legal, or any other advice, because the stock market is not a particularly easy place to negotiate unless you've got a really well thought out plan. Let's look at American stocks now. The S&P was down very fractionally and the NASDAQ was flat, but it did finish Friday with a pretty negative sentiment. But it was options expiry week. You almost always get strange patterns. You certainly get strange volumes on the day that don't really mean anything. So I wouldn't read too much into price and volume patterns for Friday, because you're likely to see them reverse next week. Technology, for the record, was the leading sector in the US for the week, but energy over the last couple of weeks has obviously done really well. The US dollar crept up very, very slightly, about 0.3 of a unit to 98.7. The 10-year yield was unchanged at just under 4.4, and the VIX was also pretty much unchanged at around 20. So let's jump in and have a look at the relevant charts. So this is the NASDAQ. Last Friday, we had a bit of a gap down, and then we had a good session on Monday where the market gapped up and the buyers were definitely in control at the end. And we're almost back to all-time highs. And then Tuesday and Wednesday, and then, of course, the holiday on Thursday and Friday finished negatively. So overall for the week, it was flat. Now, is this rolling over? Look, it's really hard to say. This could just be part of a normal consolidation around a triple top. I'd have to say that the odds are still with the price moving higher and breaking out, but that's only probabilities. That's not a prediction in any stretch of the imagination. And to be honest, for the market to be holding up within a stone's throw of all-time highs in the current environment we've got is pretty damn good, you've got to say. That is not what would have been expected when this whole thing erupted a week or so ago. So that's the NASDAQ. The S&P looks very, very similar. So we're still just in wait and see mode in terms of the indices. Now, I have had a few questions from members and also from non-members about some readjustments to portfolios to make the changes before something sudden erupts, such as perhaps America entering the war against Iran. And I've shared those thoughts very clearly with members. But it's certainly a time where thinking about what you're doing with your portfolio in advance certainly can't hurt. The spreads haven't really changed much. This is the S&P 500 versus gold. No real change there. Consumer discretionary versus consumer staples, also no real change there. So money flow's not doing a great deal. This is SMH, the semiconductor ETF. It's still remaining fairly strong. This is a weekly chart. So not much change there. And that's a positive for the overall market. Now, when we look at the individual US sectors over the last month, energy has obviously done really well, followed by technology, and then the rest are falling down the line. In Australia, energy was clearly a winner. That was certainly helped by the takeover for Santos, or the takeover bid for Santos certainly added to that. But as I've noted on many occasions, I find it extremely difficult to navigate energy policy in Australia, so I'd rather just leave the sector alone. Too hard for me. All right, so that's where we sit with the American stocks. Let's just look quickly at the currencies. Not a lot of change there. Daily chart, US dollar bounced up very slightly, and the Australian dollar lost some ground last week, as you can see. Right, turning to Australian stocks now, 63.91 is where we finished. And just thinking about the long term, it would appear, although they never really definitively say so, but would appear that US policy is more about wanting a weaker US dollar rather than a stronger US dollar. And if that is the case, and all other things being equal, then that tells you where the Australian dollar may start trading over the next year or two. The index fell 0.5% for the week and will probably open with a bit of downward pressure on Monday. There is a great deal happening in the commodity space, which obviously affects our market. Energy was strong, both oil and uranium. Materials struggled with weakness in iron ore. So that was the Aussie market. Not a lot of change there either. And one can only contemplate what might happen to the index with the major materials stocks under pressure. And if we started to see some sort of rationality around the pricing of the big banks, particularly Commonwealth Bank, then our index could be under considerable pressure. But having said that, it's a position that I've stated and thought about for the last 12 months, and it hasn't really happened. Commonwealth Bank, as one example, has always seemed grossly overvalued, and most brokers would agree with that, but the price never seems to fall. So again, the value of trading what you see and not what you think should be logically happening. Turning now to precious metals, gold was down 64. It's fairly volatile. It's jumping around quite a bit, but it's still been providing a very strong long-term return. In Australian dollars, that's 52.40, which is obviously very profitable territory for our miners. There is quite a divergence in the silver market to finish the week between the spot price and the futures price. And the consensus seems to be that that divergence is bullish for the silver price in the short term. And there was quite a strong rebound from key support, as you'll see in just a minute. Gold is at a triple top. It's forming an upsloping wedge, and we've got higher peaks and troughs. So again, if you're assigning probabilities, the probability has to be that gold will break out from here. That's based on probabilities. What happens in reality, we'll have to wait and see. But that's a pretty clear-cut chart that I'll get to in a minute. So the breakout in gold appears imminent, but silver is looking extremely strong as well. And as I covered last week or the week before, the silver to gold ratio is at a level where history shows that we should get significant outperformance by silver. That doesn't guarantee it, but it certainly weights the probabilities that way. Now, there is certainly some stories around about an exodus from London to New York of physical gold that's been occurring in recent months. If that story is valid and it's not fake news, then it strikes me that that's a very significant change in one of the world's key asset classes. So is this about US dollar devaluation and loss of trust by everybody else outside of the US because of the threats and the actions that the US has taken in recent years? I think the odds are that if this movement of gold is real, that this signals a very significant trend change in fiat currencies. Now, that's a very long-term statement. This is something that might unfold over the next 10 or 20 years. So this is not something that necessarily impacts next month or even next year. But there is certainly some significant changes in the global asset flows that bear watching. Right, let's go and look at the charts on this particular sector. So we'll look first of all at silver because that's quite an interesting chart. So this is on a daily chart. So we ended up with a bounce off this pretty important support level. Didn't quite get there, but almost. So we certainly, whilst we got 3 days of selling, you can see each of these sessions has seen buyers come in at some stage and push the price well off the lows. So that's very positive. We've had a breakout, a very robust breakout, where we then got a pause. We then got a very strong day on last Tuesday. And now we're getting some consolidation with plenty of evidence of buying support. So this is still a very positive chart for silver. This is gold on a daily chart. So you can see we've got a big triple top. We've got a wedge formation, and we've got, since the middle of May, so the last 5 weeks or so, we've got rising peaks, rising troughs. So the odds are the next move or the one after that is going to see a breakout in gold, and that would take gold up above 34.50 into new territory. Looked at in Australian dollars because obviously the currency movement has been dampening the impact. We've been in a consolidation in Australian dollar gold price since the middle of April or so, but that's still very buoyant. And just while I'm here, Bitcoin finished the week at 103,300. Now, just looking at stocks, gold stocks. So in Australia, this is the Aussie Index, GDX, the Australian listed version. We did have some pressure on gold stocks last week. There was some ratings downgrades. Northern Star was certainly one of them, and there were a couple of other stock-specific pieces of news which the market didn't take as positive that certainly weighed on the index. But there's no question that this is a very, very powerful uptrend, and we're holding above the 8-week moving average very, very easily. So still a lot of strength there. If we look at GDXJ, these are all major global producers, but just not the top 4 or 5 are in this index, and we've had a strong breakout there as well. A weaker US dollar certainly would assist what Trump is trying to achieve with bringing manufacturing back to America. So it's sort of consistent with the stated policy of the current administration. Other commodities, copper was at 482, so it's still retaining some strength, but apparently not enough to get into a breakout situation, a sustainable breakout situation above $5. Nickel is still very soft, of course, with what's happening with supply coming out of Indonesia. And crude oil, as we'll see on the chart, has been pretty volatile, but obviously a lot stronger since we've had the unfolding situation between Israel and Iran. There's the copper price. So we've been in consolidation now between 460 and 480 now for a couple of months. And there's the crude oil chart. So we had a breakdown below 60, which looked really, really ominous. And there was quite a bit of distance below that to the next support level. But the unrest in the Middle East and the threat that that brings to global oil supply and transportation has certainly changed the crude oil chart quite dramatically. So wrapping it all up, my final thoughts, is this a time for adjusting portfolios? As I said earlier, I've got very firm thoughts on this. I've conveyed those to members. But at the end of the day, it's very much down to what individual investors need. That's more of a priority than perhaps trying to get the best possible return that you can. So I think being comfortable during these periods of uncertainty is going to prevent you from making some crazy decisions. So you need to think of it in that sort of lens. So the question is it appropriate now to be reducing exposure to the market, remixing your portfolio balance, more of some sectors and less of others? There is no standard answer here. It's very much an individual decision, but any changes that you make, if you've got a good long-term platform, any changes that you make are at risk of penalising you rather than being advantageous over the long term. Another option, of course, is hedging the volatility risk, so putting some hedges in place, and you can do that in various ways. That helps to offset the volatility in the assets that you want to own for the long term. So that's another option. But you just got to recognise, and studies show this and history shows this, exiting a favoured stock, a good long-term investment, exiting and then trying to re-enter the same stocks at lower prices is incredibly difficult to do. And to do it with any sort of consistency at all. And I'm 99% sure that most people would be better off in financial terms by just sitting on what they've got, as long as it's a good, strong portfolio packed full of really strong, high-performing type stocks. So it's incredibly hard to do it, but for some people, the psychology of getting through unsettled periods takes precedence over absolute return. And if that's your situation, then that's absolutely fine. And that's what you should do. But the key message I'm trying to get across here is this is a time not just to sweep it under the carpet and feel like you'll address it on another day when everything gets really unstable. The time to think about it is now, before things get unstable, and decide strategically which course of action you're going to take. So it depends very much on your specific needs and specifically your psychological needs. You know, how comfortable are you going to feel if we enter a period of several months where the market reacts badly to what's happening around the world? It's better if you can psychologically. This, I think, will give you the best long-term return. But for some investors, this is just not what they can do because their psychology doesn't allow it. But get a spread of sectors that have got the strongest and most highly probable long-term tailwinds. And everyone should have a pretty good idea of what these are. Obviously, artificial intelligence is right up there. Precious metals is right up there. Defence stocks have got to be right up there. So get a spread of sectors that have got those really long-term tailwinds. And then within those sector allocations, select the stocks that have got the best credentials. And I've talked many times in recent months about the long-term track record of founder-led businesses. It's not perfect, but the overall average record of founder-led businesses is so far ahead of the rest of the market that it's very, very meaningful. So if you just do those two things, you're going to get much better long-term performance, and that's what we do in the Insiders Club and in Portfolio Analyst. And speaking of Portfolio Analyst this week, I'm going to be looking very much at defence stocks, both individual stocks and ETFs. So for anyone that is looking to learn a bit more about that part of the market, then there's a trial for $1 for 2 weeks. And this would be a good time to come in and have a look at what's happening in the defence stock sector. So that's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.